Here's something wild. Right now, millions of Americans are paying off a loan that'll take 30 years to finish. 30 years. You could literally be born, grow up, graduate college, start a career, and your parents would still be writing mortgage checks. And the craziest part? Nobody questions it. We just accept it, like it's always been this way. Like the 30-year mortgage is some ancient law of nature, like gravity or taxes. But here's the thing, it's not. The 30-year fixed-rate mortgage didn't exist until 1934, and before that, buying a home in America was an entirely different game. A harder game, a riskier game, one that most ordinary people simply couldn't win. So what happened? How did we get here? And what had to go so catastrophically wrong that the federal government had to step in and rebuild the entire system from scratch? Let's find out. To understand the modern mortgage, you gotta go way back, like founding fathers back. After the Revolutionary War, the U.S. government was sitting on an almost unimaginable amount of land, millions and millions of acres stretching west into territories most Americans had never seen. And figuring out what to do with all that land? That became one of the biggest debates of the era. The Land Ordinance of 1785 was their first real answer. The government carved up public land into neat grids, divided into sections, and put it up for sale. Sounds reasonable, right? Except there was a massive problem. The minimum lot size was huge, 640 acres, and the prices were steep enough that regular settlers, the farmers and laborers who actually wanted to move west, couldn't afford it. It wasn't a system for everyday people. It was a system for wealthy land speculators who'd buy big, sit on it, and sell it off for profit. So for most ordinary families, the path to land ownership wasn't through a bank or a government program. It was through sheer stubbornness. They'd move into the wilderness, build a cabin, clear some trees, plant some crops, and just hope that when surveyors eventually showed up, they'd have some kind of legal claim. Risky? Absolutely. But for millions of early Americans, it was the only option they had. Then, in 1862, everything changed overnight. Abraham Lincoln signed the Homestead Act, and honestly, it's one of the most underrated laws in American history. The deal was simple. Any adult citizen could claim up to 160 acres of public land, live on it, farm it, stick it out for 5 years, and after that, it's yours, free and clear, for a filing fee of about $10. Between 1862 and 1976, the Homestead Act handed out over 270 million acres across 30 states. That's 10% of the entire United States transferred directly into private hands. Entire regions of the Great Plains and the American West were transformed, not by banks or financial instruments, but by grit and determination. But here's the catch. The Homestead Act worked great for rural land. It did nothing for the millions of people flooding into cities. By the late 1800s, America was industrializing fast. People were pouring into cities like New York, Chicago, Philadelphia, looking for factory jobs, not farmland. And if you wanted to buy a home in one of those cities, good luck. You basically had two options. Option 1, pay in cash, full price, up front, no installments, no financing, just the whole amount. And obviously, almost nobody could do that. Option 2, get a mortgage. But these early mortgages, they were nothing like what we have today. Here's how it worked. First, you needed a down payment of at least 50%. Say a modest house cost $4,000, which was pretty normal back then. You'd need $2,000 saved up just to start the conversation. Meanwhile, the average worker was making maybe $400 or $500 a year. You do the math. That's 4 to 5 years of saving every single penny you earned. Not spending anything, not eating out, not buying clothes, nothing. Mathematically impossible for most families. But let's say you somehow scrape together that down payment. Then what? The loan itself lasted maybe 3 to 5 years. During that time, you'd make monthly payments, but here's the kicker. Those payments only covered the interest. You weren't actually paying down what you owed, not even $1 of it. And then, at the end of those 5 years, the bank would knock on your door and say, "Hey, remember that entire original loan? We need all of it now." That was called a balloon payment, and for a lot of families, it was a trapdoor they didn't even realize was under their feet. You'd spent years making payments on time, raising your kids in that house, building a life, and then one day, boom, the full bill comes due. You can't pay. You lose everything. It was brutal, and it kept home ownership out of reach for most Americans. Then came the 1920s. The economy was booming. Wages were up. Credit was flowing. People were buying homes like crazy, and everything felt great. But underneath all that optimism, the system was a house of cards. Balloon mortgages were still everywhere. People were borrowing bigger and bigger amounts relative to what they actually earned, and nobody wanted to talk about what would happen if the music stopped. Then, October 1929 hit. The stock market crashed, and what followed was the most devastating economic collapse in American history. Banks started failing, not a few, thousands. Over 9,000 banks shut their doors by 1933. Jobs evaporated, wages collapsed, and those balloon payments, they still came due. By the spring of 1933, nearly 1,000 families a day were losing their homes to foreclosure. 1,000 every single day. Half of all mortgages in the country were in default. The entire system was imploding. The building and loan associations, the community institutions that had been the backbone of working-class home ownership for a century, they were getting crushed too. More than a third of them collapsed. Members panicked. Doors closed. The home ownership rate, which had barely climbed to 47.8% by 1930, crashed to an all-time low of 43.6% by 1940. The American dream wasn't just struggling, it was drowning. And that's when the federal government did something that would have been unthinkable just 10 years earlier. It stepped in, massively, permanently. First came the Homeowners Loan Corporation in 1933, under FDR's New Deal. The HOLC did something radical. It bought up defaulted mortgages from failing banks, then refinanced them on dramatically better terms for borrowers. Short-term balloon loans got converted into 15-year fully amortized mortgages at a fixed rate around 4.5%. By the time it stopped lending in 1936, the HOLC had refinanced over 1 million mortgages. It literally kept hundreds of thousands of American families in their homes. And it proved something important. Long-term, fixed, fully amortized mortgages actually worked. They were safer for borrowers, more stable for lenders, and better for the overall economy. But the HOLC was always meant to be temporary. The government needed a permanent fix. And that brings us to June 27, 1934, the day the modern mortgage was born. Congress passed the National Housing Act and created the Federal Housing Administration, the FHA, and this changed everything. Here's the genius of it. After the Depression, banks were terrified to lend. Can you blame them? The FHA's solution was simple. The federal government would insure mortgages against default. If a borrower stopped paying, the government would cover the lender's losses. Suddenly, banks had the confidence to start lending again. But, and this is the key part, the FHA completely rewrote what a mortgage had to look like. No more balloon payments, no more 5-year terms. FHA-insured loans had to be long-term, initially 15 to 20 years, eventually stretching all the way to 30 years. They had to be fully amortized, meaning every single payment actually reduced what you owed, and the required down payment dramatically lower than the old 50% standard. And just like that, the 30-year mortgage was born. So the next time you're signing mortgage papers or dreaming about buying your first home, remember, none of this was inevitable. None of it was natural. It took a Great Depression. It took 1,000 families a day losing their homes. It took the entire housing system collapsing in on itself before anyone had the political will to fix it. The 30-year mortgage wasn't handed down from the heavens. It was built. Out of crisis, out of desperation, and out of a fundamental question about who deserves to own a piece of this country. And that question? We're honestly still working on the answer.